I am Hyung Kim, Portfolio Manager of the Kayne Anderson Rudnick International and Emerging Market Small Cap Strategies. At a high level, I would point to three reasons why we think this asset class is attractive. First, faster economic growth. Emerging market countries overall exhibit faster economic growth. Faster growth doesn't necessarily guarantee better equity returns, but higher economic growth typically attracts more capital and creates tailwind for businesses to grow. It certainly makes for a good pond to fish in for investment ideas. Second, I would say market inefficiency. Small cap in general tends to be inefficient. That is true in the US, that is true in developed countries like Europe, but it is even more inefficient in emerging markets. Many small cap companies in EM do not have sell-side analyst coverage, often do not have English disclosure, or sometimes do not have enough trading liquidity, making it difficult for large institutional investors to even consider an investment. This inefficiency often presents compelling investment opportunities for investors like us that are focused on business fundamentals with a longer-term view. And lastly, I would point to diversification benefits. Large cap companies' business results in general tend to be more correlated to the overall GDP growth rate. For example, a large company like Walmart will find it difficult to outgrow the US GDP because of its already large size, and its business results will be more of a proxy of the overall US economy. Small cap companies, on the other hand, are often influenced by more idiosyncratic business and industry drivers, whether it's gaining market share from larger competitors or growing in a niche space through innovation. This dynamic in small cap can offer more diversification benefits for investors. I think it is important to put some context to the underperformance of the last decade. If you look at the decade before last, between 2000 and 2010, emerging markets, including EM small cap, outperformed the US materially in dollar terms. EM and EM small cap generated roughly 11% annual return, while S&P 500 returned less than 0.5% per year during this decade. The decade between 2010 and 2020, S&P 500 outperformed, but if you put the two decades together, EM still outperformed S&P 500. Now, if you look at the current decade, which started in 2021, and we are roughly halfway through it, EM small cap outperformed the Russell 2000, which is a US small cap index, but underperformed the S&P 500. And we know that a big chunk of the stronger performance in the S&P 500 recently has been driven by a handful of large technology stocks. So the point that I would like to make here is that US equities haven't always outperformed, especially when you exclude the few mega cap technology stocks. And if you go further back in history, there has been many periods during which US has underperformed. So it is a bit of a recency bias to think that US always outperforms. And as it relates to the underperformance more recently, I would highlight three factors behind the underperformance of emerging markets versus the US. First, China was a big component of the underperformance. The country has underperformed due to a mix of policy concerns, macro concerns, and geopolitical concerns. And also, the strong US dollar has been a big contributor to the underperformance of the emerging markets recently. A strong dollar tends to be a headwind for non-US equities, including emerging markets. And lastly, a meaningful component of the US outperformance was driven by multiple re-rating. If you invest in our emerging market small cap strategy today, you will essentially become a co-owner of a collection of high-quality businesses that we think have sustainable competitive advantages with very interesting future prospects, trading at reasonable to attractive valuation levels. So hopefully you are getting steady earnings growth over a long period of time. You are also getting diversification away from the much more expensive US market and the US dollar, which has had a long bull run.